welcome to another episode of Daily Trader. I'm Alex Coffey in for Kevin Hinks. Thanks for joining us here on the Schwab Network. Looking at the market today, kind of a quiet session brewing here to close out what's been an action-packed, not only 1 week, but 2 weeks. We're now the day after the Fed, a few days after the U.S. presidential election in the United States. Still votes being counted on the west coast of this country, but mostly understood outcomes. A couple House races still to be determined. But when we look at the market itself, crossing 6,000 in the E-mini S&Ps for the very first time in yesterday's session, hanging out at all-time highs as we speak right now in those markets. You do see some weakness in the NASDAQ 100, though, as some of those mega cap names, think Apple, think NVIDIA, think Microsoft, a little bit weaker, pulling down that little bit more tech-heavy NASDAQ 100. A bounce back in the Treasury market. I look at the Treasury market futures for indication that you could look at yields as well. Yields a little bit lower. Treasury market futures catching a little bit of a bid. But generally, over the last month, 2 months at this point, you have seen a downward bias in those markets. And this, of course, is brought up yields on the long end. Now, the Fed did cut 25 basis points yesterday. There wasn't a whole lot of forward guidance provided for them this time around. Political questions kind of dominated the presser. So, if anything, one of the quieter Fed reactions that we've seen in recent memory. We'll see if that continues going forward. The gold market also under a little bit of pressure as it now sets, let's call it 3-4% off of highs now, which is a notable pullback in one of the strongest markets over the last few years. On the earnings front, there was a few names that did report in the last 24 hours. I wanted to focus on one as it highlights a broader, space or subsector within the market. And the name I want to talk about is DraftKings. We're going to talk about MGM as well as sort of an ancillary, more legacy player within this world. But DraftKings, I thought, had a very, very interesting earnings release. They cut their forward guidance for the quarter ahead because players were winning more than they initially anticipated. Now, I found this to be fascinating, and it also wasn't a huge surprise. Those who caught yesterday's episode of Next Gen Investing would have heard me talking about in week 9 of the NFL and a few other weeks, there had been some pretty favorite-heavy weeks. 13-1 in week 9 for the NFL, favorites straight up, and I think they were 10-4 against the spread. Now, let's put to rest some of the misconceptions about the sports gaming market. Those who maybe are a little bit on the outside looking in kind of understand there's this, hey, you're risking 11 to make 10 marketplace. And the misconception mostly, though, is that bookmakers set the line so they get 50% of the bets on one side, 50% of the bets on the other side, and they just simply take what is referred to as the VIG, that extra $1 that you have at risk versus what you can make. And in an ideal world, bookmakers around the world would love to do this, but there are countless events on a daily basis, and unfortunately, they just can't realistically get half the money on one side, half the money on the other side. So what do the bookmakers really do? They try to set the most accurate lines based off their ratings of the different teams as they can, and over time, they have that embedded advantage with that 11-10, and they hope over time, and of course, over time they have been winners. Now, they were still winners for the quarter, but it did bring down their guidance a little bit. And of course, not just straight up bets are the only thing that's happening. There's parlays in some jurisdictions. You got, of course, traditional casino games, which of course, embedded do have a disadvantage to the players. But when you look at this, though, I think it's really important is that this also is something that has sort of variance. It can bounce back and forth. And so there's a chance, too, that you might have a week coming up that's going to be really tough on the more public bet teams. And, maybe they'll have better weeks than not. So in the end, it sort of averages itself out over time. And that's why this is a business model that works. So the initial reaction in the market was actually a sell-off in DraftKings. But as kind of the message settled in and things went on, you did see the stock bought up. I also should mention, too, Oliver Rennick interviewing the CEO of DraftKings on Morning Trade Live, I think as we speak, and that should be put up on video on demand sometime today for those who miss it live and want a chance to catch that conversation with the company's leadership and some of the questions that he may have. But let's look at an example trade in DraftKings. It's still a name that kind of represents this new movement towards online betting. As I said, the stock a little bit weaker in response to earnings, but being bought up in real time. I wanted to look at a neutral to bullish strategy in this particular stock, selling a put vertical below the market as a reflection of that kind of buying of the dip that you're seeing almost in the market itself, and with the kind of line of thinking that we're laying out, which is, hey, bad weeks happen for bettors. Bad weeks happen for the books, but over time it sort of normalizes for all, and we know they have that embedded edge. That's why it's so difficult to be a winning sports bettor over a significant amount of events and bets. But what I looked at here was going out to December. We have earnings now. They're in the rearview mirror. We don't have to worry about this again for another quarter, absent any surprises, and so it allows us that luxury of increasing duration if we so choose, and we've done that for this example trade. Again, selling a put vertical below the market. In this case, selecting the 38.35 put vertical for conversational and example purposes. Some people select strikes based off of a significant technical level. Others do it because of the price that they're getting. And that's what we did for this particular example. I wanted, for example purposes, to set up a trade that had a 2-to-1 risk reward. And so it's a $3 wide spread that risks 200 and has a chance to make 100. It's $3 wide spread collecting $1 credit. Break even, you simply take that dollar away. So you start at 38, subtract 1, you're left with 37. If it falls below 35, you got a full $200 at stake, but it is risk defined, so you can't do worse than that. If it stays above 38 and these options expire worthless going into expiration, you simply keep that credit, which in this case is equal to $100 for every one of these spreads, and you would move on, and that would be a profitable situation. In real time, I'm just clicking to see where DraftKings sits over $41 or nearly $41 a share now. So you have a little bit of an embedded cushion as well. So that's something to consider with this. It's typically a higher probability of success because you're break even below the current share price. Now, moving on to a more legacy player within this space, one that has, of course, exposure overseas as well. One of the gambling capitals on the planet is actually the Macau region. And so this is a name that has a little bit of exposure to that part of the world as well. And that, of course, is MGM. MGM, one of the big players on the Las Vegas Strip as well, but also hospitality and services arms. So it's not as straightforward as, hey, they're really exposed to online sports betting. They have exposure there through their BetMGM, but it's not quite as cut and dry. It's a little bit more of a traditional casino operator and hospitality company. They reported earnings, I think, about a week and a half, maybe 2 weeks ago, and they got bludgeoned on that report. It was down over 10%. The earnings weren't terrible, but they were disappointing, and I think that's important to note. And so you saw the stock repriced to the downside. Say you're kind of looking at this broadly, and you're saying recently there's been maybe a run of bad luck for the bookmakers. Darn, those bookmakers, we're really rooting for them. I say that kind of ironically, rooting for the player. But all things and all jokes aside, when you look at these particular names, perhaps variance bounce backs their way. Maybe they have a good quarter or two coming up in the future if some of those games go one way or another. When you're looking at MGM in its response today, this is actually a name that was a little bit lower and continues to be a little bit lower here in real time. Perhaps the read-through from some of those DraftKings results and some of those read-throughs on what's going on perhaps overseas in the China region. China, again, announcing more stimulus measures to boost their economy, and the market not really falling for it the same way this time. I don't say falling for it like it can't work, but it hasn't worked. And so the market more in the, hey, prove that this is going to make a real impact, I think, point, as opposed to, what it had been, where it's sort of just buy this news item and ask questions later. So MGM a little bit weaker today. And as opposed to looking at a neutral to bullish strategy, I wanted to highlight a different strategy. In this case, it's a little bit more just outright bullish, and it looks at something with a different risk reward. So the last one had a 2-to-1 risk reward. You were risking 200 to make 100. In this case, it's still a $3 wide spread because ironically, these stocks are pretty evenly priced. They're both in the kind of high 30s, low 40s. What I looked at here was actually a call debit spread. So it's a $3 wide spread, and in this case, seeking to spend about half the width of the strike. So if you did that, that'd be $1.50. So you're risking 150 then for a spread with a chance to make 150. The other thing that you often, if you're deploying this type of strategy, one of the loose guidelines we talked about is trying to have that break even pretty close to the current share price. Now, give or take a percent or two, depending on the time frame and the width of the spread, etc. But if it's within that ballpark and you kind of just say, hey, there's a 50-50 chance it could go up or down, all else equal. Maybe you could argue with that, but if you kind of use that as sort of a layman's, basic, math probability, equal risk to reward, well, you want your break even to be kind of close then because, hey, it could happen one way or another. And right now, MGM a little bit lower than that, but within that ballpark of a few percentage points. So same expiration, December 20th, 36.39 call vertical with a 37.50 break even. You're going to need a little bit of help from the market, but you got time. The stock's trading just below 37 here in real time, so you would need a rally of about 1 2/3 percentage points. When you're looking at this, though, it's pretty straightforward. Get above 39 over the next month and a half, a chance to make 150, fall below 36, you're going to be risking 150. All other outcomes, if it's dramatically to the downside, risk defined. If it's dramatically to the upside, profit defined. So it allows you at least to express an opinion one way or another. And this is just for example purposes, the bullish version of that. But you're not going to be exposed to outlier moves in a dramatic way. So that's the difference between using a strategy like this and perhaps being a stock shareholder where you may be exposed to something a little bit more dramatic. Now, it has an expiration date. Its break even is a little bit higher than the current share price. So there's always differences, of course, between shareholding and, of course, doing an option strategy. But couple bullish strategies that we used in this for our example purposes in two gaming names, DraftKings post-earnings and MGM, more legacy casino operator. And thanks to you for always tuning in to another episode of Daily Trader. We'll see you tomorrow.